Remember a few years back, Tata Technologies was the IPO everyone was talking about. I mean, it was the first time in almost 2 decades that a company from the legendary Tata Group was going public. And it was right in the middle of that whole exciting automotive engineering space. The hype was just massive. But since then, the story has taken a pretty dramatic turn. So what really happened here? Was this just a classic case of IPO fever, or is there something deeper going on with the company itself? Come on, let's peel back the layers and find out. The excitement from investors was completely off the charts. The IPO was oversubscribed by a mind-boggling 69 times. It seriously felt like every single investor in the country was scrambling to get a piece of this action, all caught up in a huge market bull run and the magic of that Tata name finally hitting the market again. And hey, for the lucky few who actually got an allocation, it was like hitting the jackpot. The stock was priced at 500 rupees, and on day one, it just exploded, hitting a high of 1,400. That is a 140% return, instantly. The market was basically screaming, this isn't just another stock. This is a superstar in the making. But then reality decided to show up. Since hitting that incredible peak, the stock has been through a more than 50% correction. Ouch. That whole superstar narrative, it vanished pretty much overnight, leaving a ton of investors scratching their heads and feeling pretty disappointed. And that brings us to the big question we're going to tackle today. Was this simply a case of an overheated listing that was always going to come back down to earth? Or did something fundamentally change in the business itself? Let's dig in and investigate. All right, so to really get to the bottom of this, we need to cut through all the noise and, follow the money. And what's super interesting is taking a look at who's been buying and who's been selling during all this confusion. The shareholding pattern, well, it gives us our first major clue. Okay, check this out. This is fascinating. Look at this split here. As you can see, public retail investors, people like you and me, seem to be getting a little nervous and are trimming their positions. But now look at the foreign institutions, what a lot of people call the smart money. They're actually increasing their stake, bit by bit, all while the company's founders and main backers are holding on tight. This tells you right away, the story isn't as simple as everyone is selling. Nope, something much more nuanced is going on here. So before we get any further into the stock's wild roller coaster ride, let's just hit pause for a second and ask the most important question of all. Is the actual business any good? To figure that out, we have to understand what Tata Technologies really does. First thing to know, this is not your typical IT services company. Not at all. Tata Technologies provides super specialized engineering and R&D services. Think of it like this. Their engineers become a core part of their client's team, working on really complex, deep engineering problems. It's a relationship that's built on trust and expertise, and it can last for years and years. And their number one focus? It's the automotive sector. Just look at this chart. That huge blue slice shows that over 80% of their money comes from auto clients. This heavy dependence is a huge part of their story, both for why they were so successful at first and for their recent struggles. So what does this work actually look like day to day? Well, imagine a car company wants to build a brand new electric car. Tata Technologies is there right from the very beginning. They're helping design the vehicle's skeleton. They're running digital crash tests and wind simulations before a single piece of metal is bent. And they're figuring out how to make it lighter, safer, and cheaper to build. It's absolutely critical work. So here's the bottom line. When you look at the fundamentals, the business itself is solid. I mean, it's got the backing of the Tata Group, it has incredible expertise, a clean, debt-free balance sheet, and it generates a lot of cash. The business itself is not broken, period. Okay, so if the business is solid, then why on earth did the stock price tank? This brings us to the real heart of the matter, what I like to call the great expectation reset. We need to figure out if the problems they're facing are just short-term headaches or something more permanent. Man, this timeline just tells the whole story, doesn't it? Before the IPO, you had this amazing profit growth, which just built the hype to a fever pitch. Then, on listing day, expectations went into orbit, with the market pricing in this idea of 25 to 30% growth forever. But since 2024, that growth has hit a wall, leading to this massive collision between sky-high hopes and the reality on the ground. And this slide right here perfectly shows you that disconnect. At its IPO price, the company's price-to-earnings ratio, which is just a fancy way of saying how much investors will pay for its profits, was a pretty reasonable 29. But by the end of that first day of trading, it had skyrocketed to 70. The market's expectation for future growth became incredibly expensive overnight. So why did growth suddenly stall out? Well, it was basically a perfect storm of four different things hitting at once. First, the global slowdown in EV sales meant carmakers pumped the brakes on R&D spending. Second, all the economic uncertainty and high interest rates made companies everywhere super cautious. Third, the old-school auto business saw its own profits get squeezed. And finally, because Tata Tech is so deep in the auto world, it felt this slowdown way more than a more diversified company would have. The key thing to realize here is that these all look like temporary, cyclical problems, not a sign that the business is falling apart. Okay, so the short-term picture looks pretty rough. We get it. But what about the long game? This is where we have to zoom out and ask a much bigger question about the future demand for the kind of work they do. So let's just take a step back and think about the big picture here. Are cars actually getting simpler, or are they getting wildly more complex with all the new tech? Is the need for the kind of deep engineering that Tata Tech specializes in really going away?
The answer seems pretty clear. The long-term trends are actually getting stronger. I mean, cars are going through their biggest change in 100 years with EVs, software, and self-driving features. On top of that, rules on emissions and safety are only getting tougher. And the big trend of car makers outsourcing this complex R&D work to specialists like Tata Tech, yeah, that's not going anywhere. So here's the crucial takeaway. More complexity means more engineering work. It's that simple. The long-term demand story isn't broken at all. It just got back to normal after a period of insane hype. The total amount of work available for companies like this is actually growing over time.
So after putting all these pieces together, the strong business, the big reset in expectations, and the fact that long-term demand is still there, what's the final verdict? Well, it really seems to boil down to a simple test of patience. Valuations has definitely cooled off, that's for sure. That PE ratio we talked about has come all the way down from a dizzying 70 to a much more reasonable 37 today. But while it's more reasonable, it's not exactly in the bargain bin just yet. The real question has shifted from worrying about the past to looking at the future recovery. And this quote just sums it all up perfectly. The easy money from the stock just getting more expensive is gone. From now on, any real returns for investors are going to depend almost entirely on the business actually getting its profit growth back on track. So let's wrap this all up. 1, the business itself, it's fundamentally strong. It's not broken. 2, the problem was a perfect storm of a temporary slowdown crashing head-on into crazy post-IPO expectations. 3, the valuation is way more reasonable now, but it's not a screaming deal without a return to growth. And 4, the outlook is really a test of your patience. Any big upside from here is tied directly to when that earnings growth comes back. And all of that leaves us with the million-dollar question. What you have here is a fundamentally solid business that got hit by a temporary but perfect storm. The market is clearly disappointed right now. So the real question for you to think about is this: is everyone else's disappointment your long-term opportunity?